Let's see what our experts have to say. What a crowd we have today. What a crazy crowd. Art Laffer, former Reagan economist. There he is. Steve Moore, host of More Money on WABC Radio. And if that weren't enough, Jason Trennert of Strategas Securities, CEO. Gentlemen, thank you very much. Arthur, I begin with you. You used to be a very good forecaster, so I'll ask you, even though it's a crapshoot, what your jobs estimate is. And in general, how is the labor market? You know, more people have to be working. We were over 160 million Americans in that. It's actually 163 million on the household survey and 160 something on the non-farm payroll. How's the labor market, Arthur? How is it? How are people working?
I think the labor market looks fine, Larry. I think you're completely correct on the opening riff. One thing you have to realize here is we have a real problem with seasonal adjustments, which means that if the revisions are down historically, they should be up later on these latest numbers. And the other thing that affects these numbers is the closing of the border. I mean, when you've closed the border and you do the establishment survey there will be a lot of those people not finding jobs because they're not here or they've been sent back. So all of those things play. But I think the labor market is just fine, Larry, and I'm not worried about it, especially not on a one-month basis. It just doesn't make any sense to worry on that.
Well, Steve Moore, and okay, I think Arthur is right. That is my view. But nonetheless, we've had all these very large downward job revisions in recent months. By the way, it's not just recent months. I should say recent years. E.J. Antoni is a very smart fella, but it's nothing. I mean, he's not even in place yet, I don't think. It's going to take a long time to change that. So how do we read that? If we have more downward revisions, Steve, what do you think that means? What does it spell for the economy? What does it spell for the average person, you know, the blue-collar wage earner?
Well, Larry, thanks for having me on. By the way, I entirely 100% agree with you that Lisa Cook should recuse herself from this next meeting at the Federal Reserve Board. You cannot have someone on the Federal Reserve Board who is, you know, she's not been found guilty. She's innocent until proven guilty. But how in the world, when there is this evidence against her, can she possibly? We know that mortgage fraud is what caused the last crisis in our economy. So she should do the right thing and pull herself off until this is resolved.
All right. So why hasn't Jay Powell suspended her? Pending the outcome of the investigation.
Very good question.
Why hasn't he suspended her? That would be the classy thing. You know, if you're worried about Fed credibility and independence, okay, and this guy has a terrible record on both of those subjects, he should suspend. He suspended, or actually Richard Clarida acted much more honorably, and he resigned from the Fed, if you remember, years ago, and he was exonerated for many misdeeds.
So I've also discussed it, since we're on the subject, with people like Elizabeth Warren, who are just saying, oh, she's the one who made her name on all the mortgage fraud, and now she's defending this woman. I just don't understand this logic. Okay, now I'm with you entirely. I think this economy is looking really good. You're right. I can't improve on what you said. The job market is softening. Arthur is right. Part of that is due to the fact that we have, fewer immigrants working, and the other part of this, I have to say, is there have been supply chain problems because of the tariffs, no question about that. So some firms have had to lay off workers as a result. But I love the direction of this economy. I love the investment spending. I love the fact that you've got, inflation is coming down. Gas prices are headed to $3 a gallon. These are all very positive signs for the economy, and so I remain very bullish.
But Steve Myron said, I'll go to Jason Trennert on this. Jason loved. Steve Myron said today in his testimony that there is no tariff inflation. He said actually goods prices are coming in lower here in the U.S. than they are overseas, even though we're the ones putting up the tariffs, not them. So what is the inflation story? And therefore, Jason Trennert, what is the interest rate outlook? The 10-year, I'm going to call it 4.25, okay? Whatever it may be exactly today. It hasn't done anything, all right? Hasn't been a problem. What's the interest rate outlook? What's the inflation outlook, Jason Trennert?
Well, listen, we spend a lot of time looking at corporate profits and also the transcripts from the earnings calls. And I would say that there's very little evidence that the tariffs are having a meaningful impact on corporate profits. You mentioned maybe the NIPA profits, which are up about 5%, but the S&P 500 profits are up. I think they're up 13% in the second quarter. And of course, profits in a capitalistic system, profits are tend to lead to good things like capital spending and employment. I think just to take another moment here, we put out a piece yesterday. We think there are 3 things converging on 2026, 3 or 4 things that could make it a boom year. So not only do you have the one big beautiful bill that'll result in big tax refunds, but you also have the 250th anniversary of this country and the World Cup. And so you put those things together, it looks pretty good.
Tell me again what the World Cup is.
Oh, I think that's soccer.
Oh, it's soccer. Okay, that's right.
Yeah. You can't use your hands.
I see. Okay, no hands. No, I got it.
But so there is a chance long rates rise just on real growth, and not because of inflation. But that's okay. That's consistent with what you want to have happen. But I would argue right now the markets are not telling you, the interest rate markets are not telling you that there's an inflation problem at all. I tend to go with the markets more than I go with people like us.
Yes, people like us. Art Laffer, speaking of people like us, let's go back. It's an interesting piece written by our friend Larry Lindsay, who's a very good economist.
Yes.
He goes back to the 90s, particularly Bill Clinton's second term, roughly between 1995 and 2000. 1995 and 2000, the economy grew in real terms at 4%. The inflation rate was about 2%, okay? The point, though, was, and this is interesting, interest rates were a lot higher then with that growth than they are today when everybody wants rates to come down. The Fed funds rate was 5 to 6%, Art, and the 10-year note yield was like 6 to 7%. Much higher today. The 10-year today is 4.25%, and the Fed funds rate is 4.25%. It's on its way down, I know. So you know what? If you have 4% plus growth, which we're all thinking could happen, at least for some period of time, are we sure that interest rates have to go down a lot? I can see going down some, Arthur, but a lot? What's your thought on this?
I think this is exactly correct. If you look at interest rates, there are 2 components. There's the expected rate of inflation, and there's the expected real return on a unit of capital. Both of those together combined. This is the Mundell conflict, if you will, paradigm. And, if you get real growth and the tax cuts in and all of this stuff working in the big, beautiful bill, I would expect real growth to accelerate, and it could, in fact, get to 3 or 4, or even maybe for short periods of time at 5%. That would lead to an increase in the expected real return on capital, and that would lead to higher interest rates and lower inflation rates, and that is exactly what we want. No one wants an interest rate down to 1%. They just don't want it. What we do want is the inflation component down to 0. That's true, but we want real returns high, and I'm expecting that to happen with this Trump policies. I mean, all the policies across the board signal faster growth, better economy going forward. And the idea, Larry, that tariffs raise prices is silly. Tariffs do raise the price of imported goods. That's true. But tariffs also lower the prices of exported goods because of the Lerner symmetry theorem. Now, when you look at what happened with the Smoot-Hawley tariff, which was the biggest tariff ever, prices fell like mad after that tariff bill was put into place. What happened under Nixon when tariffs were put in 1971? That 10% across the board tariff. We had lower inflation, not higher inflation. History and theory both tell us that tariffs do not lead to higher inflation. Now, they do lead to chain link problems.
Right.
That's true. Steve is completely correct. But they don't lead to inflation, and they talk about it all the time. It's just silly.
But Steve hates tariffs, so I want to address this to him because it's a terrific thing. It is important. It's very interesting. Actually, Liz Peek made this point yesterday on the show. The bond market has come to love tariffs, Steve. because tariffs are generating lots of revenues. I know you hate this, but this is the reality. We're probably cruising, I don't know what the final number is going to be for calendar 2025, but it could be as much as $400 billion, which is makes the deficit lower, makes the bond issuance a little less, could help nudge interest rates down. The bond people have learned to love tariffs, and I think the stock market people have figured out it isn't going to be Smoot-Hawley or anything close to that, Steve. So are you going to follow the bond market and learn to love tariffs?
Well, I never thought I'd see the day when Larry Kudlow was cheerleading a $400 billion tax increase, but I'm only kidding you, Larry. And by the way, I wasn't...
Lower deficits.
I wasn't saying...
Lower bond rates.
Of course, you love it. You're Larry Kudlow, the deficit hawk. I wasn't making the case that... I wasn't making the case that the tariffs caused inflation. I was saying I think they've caused a little bit of a slowdown in economic activity in middle manufacturing. But I'll give you one other statistic why you're right about the direction of the economy. We just calculated from the new Census Bureau data that over the first 6 months, you ready for this, Larry? The first 6 months of Trump's second term, real median income for families is up $1,100. So this idea that the middle class is collapsing, it ain't true. This is an expansion that is benefiting everyone.
No,
all boats are being risen.
Yes, no. Absolutely, the blue collar boom and tax-free tips and overtime pay are making a big contribution. Jason Trennert, going to give you the last word. Lightning round. Do we get to Dow 50,000?
Well, this is the trick in terms of what we were just talking about, because I do think it might be a little difficult to keep getting new highs on the stock market if interest rates rise, especially for what we call long duration assets, which is a euphemism for companies that don't have profits. So lower interest rates have benefited them quite a bit, but there is a very good chance that the policy mix that we have will be very good for Main Street. It may not be as good for financial assets, but that's okay. That's the whole point.
Are you telling me to sell my stocks? Are you telling me
so
after 40 years I should sell my S&P index fund? Jason,
no,
this is the most disillusioning thing I've ever heard. This is the most disillusioning segment I've ever done as a TV host over 25 years.
No, listen, people shouldn't sell anything. It's just things might slow down a bit. We've very much benefited from very low interest rates for a very long time, and things are normalizing, which is
more to be revealed.
What we want.
All right.
Larry, can I just add one thing?
No, you can't.
Trump did say
we're out of time. We're out of time. You cannot add anything more. Steve Moore is now for tariffs and lower bond rates. Jason Trennert just told me to sell my index fund. This segment is not exactly what I expected it to be. That's why I don't want you to say anything else. There's no telling what's going to happen here. Plus, we're out of time, and the producers are yelling at me. Thank you, Art Laffer. Thank you, Steve Moore. Thank you, Jason Trennert. We appreciate it very much.